Here is a $40,000 move that feels perfectly reasonable and quietly raises your costs in 3 separate ways. You are 66, comfortably retired, and you pull $40,000 from your traditional IRA to cover the year. First, the IRS taxes that $40,000 as ordinary income. Second, depending on your other income, it can drag a chunk of your Social Security benefit, up to 85% of it, into taxable territory. And third, because Medicare sets your premium by looking back 2 years at your income, a large withdrawal today can push you into a higher Part B surcharge the year after next. You did nothing wrong. You simply used the only account you built, the way almost everyone builds it. I am your guide to real-world retirement math, the retirement tax decisions that tend to get skipped until after the damage is done. Today, 3 tax-free tools. In the U.S. Retirement Code, plus a bonus income tool. Money that grows for years and comes out with no federal income tax due. Nothing hidden, nothing bent. These rules are written directly into the law. And here is the part most retirement planners skip. It is not enough to know these accounts exist. The order you fill them and the window in which you fill them determines whether the tax savings are real or theoretical. For many households, that gap runs to tens of thousands of dollars over a 20-year span. And when we reach the order section at the end, I will show you that gap in dollars, not a concept. 3 parts, then a bonus. Part 1. The Roth IRA and Roth 401k. The tax-free account many retirees already have and consistently underuse. Part 2. The HSA. The triple tax advantage vehicle your payroll department mentioned once and never explained. Part 3. The 0% long-term capital gains bracket. The feature of the tax code that can hand a married couple tens of thousands in investment gains at 0 federal tax in the right window. And a bonus, municipal bonds, which keep interest income out of your taxable picture entirely. Quick ask before we open Part 1. If this kind of tax code breakdown is useful to you, tap like and subscribe now, so these keep showing up for you. One foundational difference first: tax-deferred versus tax-free. Most retirement accounts in America, the traditional IRA, the traditional 401k, are tax-deferred. The government gave you a deduction when the pre-tax dollars went in and is waiting for its share when they come out. Every pre-tax dollar you pull adds to your provisional income and can make up to 85% of your Social Security benefit taxable and can push you into higher Medicare cost tiers. That money was never fully yours. It is borrowed money, and the IRS is the bank. The 3 tools ahead work differently. The government has already been paid, or the rate itself is 0. Part 1. The Roth. The tax-free account many retirees already own and underuse. A Roth IRA or Roth 401k is funded with after-tax dollars, no deduction when you contribute. In exchange, the money grows without any annual tax drag, and qualified withdrawals in retirement come out at 0 federal income tax. 0 on the earnings, 0 on the principal. That is tax-free, not deferred. To qualify for a completely tax-free withdrawal on the earnings, 2 conditions must be met. You must be at least 59.5, and the account must have been open at least 5 tax years. Your own contributions, not the growth, can generally come out any time without penalty, since you already paid tax on those dollars. Roth 401k withdrawals follow your plan's own rules, so check those terms first. And if you convert a traditional IRA to a Roth rather than contributing directly, each conversion starts its own separate 5-year clock before those dollars are penalty-free under 59.5. Generally not a concern for retirees already past that age, but worth knowing. The feature that catches most people off guard: a Roth IRA owner is never required to take a single distribution while alive. A traditional IRA forces you to start at 73 if born 1951-1959, or 75 if born 1960 or later. Ordinary income that can crowd your tax return exactly when Social Security has started and your provisional income is already sensitive. A Roth sidesteps that entirely. Now the backwards mistake worth walking through. A couple retires at 63. Their combined Social Security has not started. Their traditional IRA sits at $350,000, and they may have 3 or 4 years before Social Security, a decade or more before RMDS. Their taxable income during that gap may be the lowest it will ever be. That is the window. Converting $20,000 to $30,000 a year during it, paying ordinary income tax now at a lower rate, shrinks the balance that will eventually force RMDS and moves those dollars into a bucket that never generates a tax bill again. Most people who miss that window do not miss it because they did not care. No one showed them it had an expiration date. The second mistake, never opening a Roth because income was too high for direct contributions. The income limit applies to direct contributions only. There is no income cap on conversions. Any pre-tax traditional IRA can be converted at any time, regardless of income. You simply pay ordinary income tax on the converted amount that year. One caution: a conversion is not free. A large, poorly timed one can push your provisional income past the Social Security taxation threshold, or push your Maggie into an IRMA tier that raises Medicare Part B and D premiums. The right size to convert each year is a number, not a concept. Calculated before December, not discovered the following April. Part 2. The HSA, the stealth retirement account hiding in plain sight. The health savings account is the most underused triple advantage account in the U.S. tax code. Layer 1. The contribution is tax deductible, dollar for dollar, regardless of whether you itemize. Layer 2. The money grows tax-free inside the account. Dividends, interest, capital gains, none of it taxed. Layer 3. Withdrawals for qualified medical expenses are completely tax-free. No other account delivers all three at once. A traditional 401k gives you a deduction going in, but taxes every dollar on the way out. A Roth gives tax-free growth, but no deduction going in. The HSA does all three for qualified medical spending. For 2026, the IRS set HSA contribution limits at $4,400 for self-only coverage and $8,750 for family coverage under a qualifying high-deductible plan. You cannot contribute once enrolled in Medicare, so the window to build this account is your working years. Here is the feature that turns it into a genuine retirement asset. Once you turn 65, you can withdraw for any purpose, not just medical. Non-medical spending after 65 is taxed as ordinary income, same as a traditional IRA. But qualified medical withdrawals stay completely tax-free at any age. The backwards mistake, treating the HSA as a pass-through. Contribute in spring, spend it on copays by fall, and the account never builds. The more powerful approach is to invest the balance, let it grow, and pay current medical bills out of regular savings. The IRS sets no deadline on reimbursing yourself for a past medical expense as long as it occurred after the account was opened and you kept the records. Every receipt you hold is a future, tax-free withdrawal on your schedule. Say a couple has done this for 8 years, invested and untouched, with $14,000 in documented receipts. In 1 year of retirement, they pull that $14,000 from the HSA, tax-free, to reimburse those past expenses. It does not raise their adjusted gross income, their provisional income, or touch their Medicare premium calculation. It simply does not show up as a burden. Healthcare is consistently one of the largest costs a retired household faces. Arriving at 65 with an HSA invested for years gives you a tax-free pool sized for exactly the expense category that grows the most in retirement. Part 3. The 0% long-term capital gains bracket. This third vehicle is not a single account type. It is a feature of the tax code that applies to assets held in a regular taxable brokerage account, with no contribution limits and no required distributions. Long-term capital gains are profits from assets held more than 1 year, stocks, mutual funds, ETFs, real estate. The federal rate follows a separate, lower schedule than ordinary income, 0, 15, or 20%, depending on your taxable income. For 2026, the 0% rate applies below $98,900 of taxable income for a couple filing a joint return, or $49,450 for a single filer. The official revenue procedure, 2025 32 figures. Below those lines, the portion of gains that fits within your remaining room is taxed at 0% federally. In practice, a married couple, after the $32,200 standard deduction with $40,000 in taxable income from other sources, has roughly $58,000 of room before the top of the 0% bracket. A measured sale of appreciated stock, sized to stay within that room, produces no federal capital gains tax at all. This is called gain harvesting, and the most valuable time to do it is the low-income years between retiring and the start of RMDS and Social Security. Once those begin, ordinary income expands and the 0% room shrinks. The window is widest exactly when you are least likely to think about it. One caveat: long-term gains add to your MAGI, the figure that determines ACA subsidy eligibility and IRMA surcharges on Medicare Part B and D. The room inside the 0% bracket and the room before those MAGI cliffs are not always the same number. Worth calculating before you sell, not after. Bonus tool: municipal bonds. Interest from state and local government bonds is excluded from federal gross income by statute. Compare it to a treasury using tax-equivalent yield, what a taxable bond would need to pay to match the muni after your bracket's cut. For a retiree in a high enough bracket, a muni yielding 3.5% can leave more in your pocket than a treasury paying the same 3.5%. In a low bracket, the advantage shrinks, and a treasury can win once you weigh state taxes and credit quality. One caveat: muni interest, while excluded from federal taxable income, can still count toward provisional income for Social Security taxation and toward MAGI for IRMA. It is not invisible to every calculation, so check with your tax professional before shifting a large allocation. Now, let us pull all three parts together, plus the bonus. The honest reframe: none of this is hidden. Some competing videos present these accounts as hard-to-find arrangements most people are never told about. That framing overstates the case. The Roth exists because Congress decided money taxed once should not be taxed again on growth. The HSA exists to encourage Americans to save for healthcare costs. The 0% bracket exists because Congress decided moderate income investors should not face a federal tax on gains they spent years building. All three are in the published tax code. What comfortable retirees do differently is fill these accounts deliberately, sometimes a decade ahead, then manage their income to stay in the most favorable brackets. The planning happens before the outcome, not after. Here is the filling order that tends to work. During your working years, max the HSA if you have one, invest the balance, and pay current medical costs from regular savings while you keep every receipt. If a Roth 401k is available, direct some contributions there. Once you retire and the low-income gap opens before RMDS and Social Security, calculate whether converting a portion of your traditional IRA makes sense, staying under the thresholds where Social Security becomes taxable, or MAGI trips an IRMA tier. In that same window, check the room inside the 0% capital gains bracket and harvest appreciated positions if it makes sense. And throughout retirement, let the HSA compound until you need it. Picture two households, both retiring at 63 with $450,000 in a traditional IRA and $80,000 in a taxable account with embedded gains. One draws from the traditional account every year and never revisits the bracket math. The other converts a measured amount each year during the low-income gap, harvests gains when room allows, and holds the HSA for later reimbursement. Over 20 years, the cumulative difference in federal tax paid between those two households can reach into the tens of thousands of dollars or more for larger balances. A planning illustration, not a guaranteed result, but the scale of what this ordering is designed to close. The goal is income flowing from several buckets at retirement: the traditional account at a rate you manage deliberately, the Roth at 0, the HSA at 0 for medical expenses, and gains or muni interest at 0 or a low rate. That layering holds your effective tax rate down and helps protect your Medicare premiums from climbing. Here is the one rule to carry from today. Tax-free retirement income does not arrive on its own. It is something you build years in advance by acting in the windows that close once your income picture changes. This is not financial advice. Every situation is different. Run these numbers with a qualified fiduciary and a tax professional who can look at your full income picture. If this gave you a number worth running, hit the like button. Subscribe if you want this kind of retirement math broken down every week, and drop one word in the comments: triple.